So recording. In front of you is a chart of the ES daily. So, you ready, Tom?
Thank you, Peter. Yeah, hi everybody. Tom Williams here. Lovely to talk to you. Yes, we've got, this is a daily chart of the S&P future. And you can see that it's basically not doing a lot today. We do have this shakeout in the background, which is why we got higher prices, right? It whipsaws though to make sure that you're confused and don't know what's going on. Look. However, we do know what's going on here. Market goes up, pushes through the top here, right? You would expect high volume if it was bullish. It's not all that high. It's fallen off, look. Why would you want high volume? Because that would be pushing through supply to the left. In the top of these markets here, there won't be hundreds but thousands of traders locked in, and they're not too happy when you get these falls like this. That's why they're there. And then if the professional money is bullish, they will push through that, and if there was any selling from these people who are locked in, they would be prepared to buy it off them. But here it doesn't appear apparent. There is high volume on the previous bar, which means there must be a bit of supply there. And it looks a bit like a test outlook. So there's a bit of supply there. It goes up there. The volume falls off. So technically it's no demand. Professional money would see that as it rushes towards that top trend line. And what do we see? We see up bar, narrow spread, lowish volume, closing in the middle. The computer sees that and said, right, now you told me years ago that that was no demand. So I'm putting the signal up for you. And there it is with the dialog box. No demand. Now you would expect the price to come off, right, because it's hit the top trend line. You've got some sort of up move here. So the market's vulnerable to one or more professional groups deciding they want out at the moment. And there it is. That can only be lack of demand. Up bar, narrow spread, close in the middle, and the volume is less than the previous two. Look, that is classic no demand. And that's all the computer can see. The computer can only see just what I've told you. Turns around, there's another arrow, look. What's that say, Peter? Well, weakness has appeared, it sure had. That's confirmation of the previous bar is weakness. Down it goes. Now we've got another signal coming saying there is a bit of strength coming in. Right? But nothing much is happening. We'll have a look at a different time frame and see what's going on. But that's the overall picture of the S&P future. And it is slap bang in the middle of a trading range, so you have to be careful here. Because when they're in the middle of a trading range, it's more vulnerable to shoot off in a direction you're not prepared for. At least here, you expect lower prices when it hits that top trend line on a narrow spread, close in the middle, volume less than the previous two. Look, that's a classic no demand. Classic. If you're going to write a book, that's the example you would want to use right there. Look, that's all the computer knows. Doesn't know anything else. Doesn't know anything about news. It doesn't know about any gut feelings. It doesn't know what the broker said or the guy next door is saying. That's all it knows. And there. Now, before we go to another time frame, we'll still keep to the S&P because it looks interesting in a way. Are there any questions about this daily chart of the S&P 500 futures? Nothing. Rita, look at the screen. Nothing. Good. Can you put up 30 minutes, see what's happening there? That's 30 minutes, is it? Well, you can see it's whipsawing around a lot, isn't it? There's been some strength in the background here, look. Right, what's that say, Rita? Oh. Shakeout, right, good. That'd be a test there, look. Is that low volume? Right, okay, it doesn't matter. But we've got shakeout in the background. Now that's interesting in a way, because you've got this down bar, right? It's not easy to see exactly what is happening there with the volume. And because of that, look, we could see in hindsight it didn't really go very far. But we do have this here in the background shakeout. Up it goes. And it's obviously hit some sort of supply, look. Right, well, all buying climax means is the supply has come in and hit that market. It's gone way up into the fresh high ground, look. When I say fresh, I mean there's nothing to the immediate left. It's closed almost in the middle, look. The volume has increased considerably relative to the previous volume. Okay, and that's why it's come up with a signal. And that's why it's come off. So the market's whipsawing around, plummets down. There's some more signs of strength has appeared, look. So on that, it basically seems to be going sideways. And we know from the daily chart it's almost in the middle of a trading range. So it's vulnerable to either go up or down here. Any questions about a 30-minute chart? Rita says yes.
Okay, question. If you are short the ES, then how do you stay with the trade for a deeper move when following the no demand and the selling previously and NQ and TF being very weak in their short-term trends? So that's NASDAQ and... we don't know. So, Tom, if you're short the ES, then how do you... the Russell. So if you're short the ES, then how do you stay with the trade for a deeper move when following the no demand and the selling previously and the NASDAQ and Russell being very weak in their short-term trends?
Well, that's easier to say than actually explain, because the first thing you've got to realize is they don't want you making money. And that's why they whipsawing up and down. But if you short up bar, narrow spread, close the middle, volume low, as it hits that top trend line, as we saw on the daily chart, then you've got the trend heavily behind you. So they can't do a lot about that. But here in these charts in the middle there, they're whipsawing it. They don't want you making money. And the whole thing seems to be geared up to whipsawing it around like this. Only experience would sort it out for you. Technically, if you're writing a book, you would say that if you go short, you put a stop above on odd number, the position you went short, And every time it goes down, it goes back up and then down. You move the stop to the lower high. That's how you would explain it in a book. And therefore, but you can see how it's whipsawing around. I personally, you can go short. There's lots of places where you can clearly go short. But right now, look at this chart. You'd have to be pretty smart to pick out a really good short or even long position with a whipsawing like this. We're in the middle of a trading range. We got weakness right over us. And on this 30-minute chart, look, there's weakness there, look. See, by this, definitely looks like some sort of up thrust. And then you've got these whipsawing down bars with buying on. And don't forget, professional money is always not quite sure themselves where they are. A lot of these professionals do lose money and can lose money. But what my advice would be that you do not do anything unless you see a clear principle that you can interpret and it's pretty obvious to you what it is. Right now, I would say there is not that clear principle at the moment. We've just come along, 5:30 Friday UK time, right? We just have to accept what they're giving us. Look, I don't know how Gavin's getting on with this new project with this Russian programmer. They are supposed to be producing a new chart which the arrow signals won't come up, and this is a fairly obvious, straightforward principle at work. In other words, it should narrow down your guessing considerably. And we can see all this stuff in hindsight very clearly. But that daily chart we started off with, the top is very clear, isn't it? But the trouble is, when you see that, you're sitting there and you see that up bar and a narrow spread hits that top trend line. You have to be prepared to do something about it. But part of the failure of human traders, if you're not professional, is you sit there looking at it and say, oh yeah, that looks weak. I'll wait and see what happens, just to convince myself. And then usually it's too late. That's why you get those horrendous wide spreads up or down to lock you and other people in or out of a trade. The whole thing appears to be geared up to put you off. Okay? Any other questions, Rita? Okay, hang on a minute. Right, we just look at, I'll tell you what, I was looking at the 4 hour earlier on, that kind of looks fairly interesting. That it there? Lost it. Oh, there. All right. Yeah, now this is a 4 hour chart, look. Now, it's getting on a bit, 4 hours, isn't it? It's almost... Now, as it plummeted down there, right, it does look like stopping volume. Why is that stopping volume looks like? Because the next bar's up and you're vulnerable. In other words, you've got a quite considerable fall behind you. That makes it possible, it's stopping volume. That's what the pros are looking for. They're looking for an opportunity to make money. And if the market has fallen considerably, look, all right, Look at that up. Look at that no demand there. Look, classic. No signal on it, but look at it. Up bar, narrow spread, close the middle. Look at the volume. Look. Can't want better than that. But anyway, the market's vulnerable, and that's why they will step in and buy. It looks as if they're buying there because the next bar's up. Look, and we've got automatic signals here. Test after shakeout. Look. So that's true. That would be a shakeout, and that would be a test. On that, it's gone sideways, look, for some hours. Don't forget, this is a 4-hour chart. The market has fallen, and the volume is low, back into this level here. Right, so if we draw a line where the initial high volume was, it is more or less there, and the volume is low. However, on saying that, you would expect higher prices. It went up, look, made the attempt, but the volume is too high, look. It hit supply. It was marked up. It's closed almost in the middle, look. And the volume has obviously increased considerably. There's too much supply there. And this is why, at the moment, this market appears to be knocking sideways like this. So this is an example of a chart of a bit longer term than normal. Now keep in mind, we're only really looking at opportunities to scalp the market. I've said this before. If you were a fund manager like Philip Friston, you'd be looking for longer time frames. You'd be looking at daily, weekly, excuse me, or even monthly chart to position your portfolio as a fund manager. But we can't do everything in an hour Friday afternoon or wherever you are. But so that's why it's, to us, scalping's a bit more fun. You can go in, buy or sell, make a few $100s, and then close it out and go and have a cup of tea or something. This is all we're doing at the moment. But you can read these markets. But this looks as if it wants to go sideways at the moment. There's a question, right? Okay.
Yes, it's from Edmund, who says, does the second last bar look weak with the high volume up bar and the price off the top?
Well, that last bar you're talking about is definitely supply on it, look. Now, you might say, well, it is weak, but it's not, I doubt if it's weak enough to cause too much of a bear move. But that remains to be seen because you've got this stopping volume in the background. Remember, it's the background's important. All right? Always keep in mind the background. Imagine now you go to the bank and you want a loan. Now, you sit in front of the bank manager, he looks at you. Now, you may have put your Sunday best on and combed your hair nice and done everything. But what he's really interested in, what is your background? If they lend you money, will you pay it back? They want to know the history of your background. What's in the background? And if they see a good record, right, that's okay for them. But if you've got a bad record, or there's weakness or something wrong in the background, then it's not so good. So try to keep that in mind. The background's very, very important. The leading edge of the market is doing what it's doing, or whatever it's doing, because of the background, or the near background. Professional money are fully aware of what's happened. The same as you would be if you were in that position. Ellie wants to look at SKF. Right. Here we go. Something wrong there. Eleni, what is SKF? What is stock or something? That's not right, Peter.
Okay, so the other one she suggests is
Cotton.
cotton.
Oh yeah, we've cotton. That's right. Hang on, we just have to. We just have to reboot the machine quickly. Cotton. I think we looked at that before, haven't we? On several occasions. Ultra shorts. Oh, I'm sorry, I'm not into that world. But we look at it. But let's look at cotton, shall we? Here we go. Peter's fiddling around here. We're looking for cotton. Right, sorry folks. I know cotton, I think it's on continuous contracts, is it, or something? Well, when you think about it, the complexity of the stock charts, all that data, all those different charts thrown in with the internet, so I wonder if it works at all. Okay, yeah, so here we've got cotton, look. I think we looked at cotton before, haven't we, Rita?
Oh gosh, yes.
But that looks weak. I mean, we start off from the top here. Test. That's a failed test, look. Anyway, it's coming off. That looks like a weak bar because it's got a top tail, look. Although it looks like a test, it's not a test because it's got this top tail to it. Don't fall for that one. When you see these bars with these huge top tails, that's definitely not a test. That's a weak bar, a sign of weakness, because it's obviously been marked up during the day and either supply or no demands hit that. So off it comes. Down, there's a wee little bit of support there, not much. But that's a weak bar, look. It's been marked up. It's hit no demand probably. And it's still falling as we look at it. But remember, these markets, they're professionally driven, especially cotton. Usually they're easy to read because their professional money's in there trading it. And they tend to be more orderly and easier to read. I've never traded cotton, to be quite honest. But that looks weak. It certainly doesn't look as if it's getting ready for an up move at the moment.
Say this. Eleni says she went short at 94.14. If that's, am I correct, Eleni, in what I'm saying? And covered the shorts at 90.80. So 90.80. 90.80. Right down there. Tom's said that's very good. Do you want me to say, Tom? No? Do you want anything? Do you want to say anything? Okay. Okay, so Thomas is saying, when you have a VSA sequence and it falls off the chart before a change of behavior occurs, can it be disregarded in the future? Say that again. When you have a VSA sequence and it falls off the chart before a change of behavior occurs, can it be disregarded in the future? Do you understand? Could you explain that, Thomas? Give us a little bit more, because we don't understand your question. We're not sure. While Thomas is doing that, BSX for Pete. Let's see if we can get that working. That doesn't exist. Yeah. BSX. Oh, we've already got it up there. That's BS. It's Boston Scientific, Tom. It's a medical device maker.
A medical device maker. Now, I know there's a lot of money in coming up with medical devices in America, because I believe these hospitals, if a patient, like for example, gets a bed sore, then if they don't have the vibrating mattresses that's supposed to prevent it, then they're open to being sued. So they have to buy all this stuff to make sure they're really up there with all the technology and the latest aids. And that's why there's always a lot of money in these so-called medical devices. And so the reason I know that is that we had a VSA user in England, believe it or not, who invented a new vibrating mattress. We're going back about 30 years. And because it worked and because it was so good, they had to buy it off him for $40 million at the time. He was in my office. I was talking to him. And that was the reason. Because if there's technology available that's going to prevent something, if you don't have it, then you're open to being sued for negligence, I suppose. I don't know. I'm not a lawyer. But that's why these stocks do so well normally. So here we are. We've got it. We'll have a look back here. We've had a down move look. There does appear to be some stopping volume. And here, look, after stopping volume, yes, potential. We put the words potential in there because we don't really want to say anything definite. As you know, that's very difficult to say in the market because understanding these charts is an art. It's not a scientific scientific certainty, should we say. So it does look like stopping volume here, look, definitely. Okay, so we've got this down bar here into what I call fresh low ground. That means there's nothing to the immediate left. And I say immediate, right? And it looks down bar, fresh low ground, narrow spread. Don't forget, we're looking at volume spread analysis. So it's not only the volume we're looking at the price spread. and we can see it's down, narrow spread. That means that the lower part of the bar must have been supported, and it closed in the middle, look. And there's the high volume coming in, and that's why it went up. However, we expect that to be tested. Up it goes. I suppose that's no demand. It comes off, look. Look, see how they make it difficult for you. They do a little blue up bar. But if you know what the blue up bars, the weak ones, look up, close in the middle, low volume. It's gone up on no demand. But there's the test, look, there. So we do have a test. And the volume is relatively low. So that definitely looks more bullish than bearish. At the moment, look, it's probably waiting for the index to rally. That definitely looks bullish at the moment. And if you get any signs of strength in the Dow or the S&P 500, that looks definitely as if it wants to go up. Because you've got stopping volume here in the background. Well, first of all, we know it's stopping volume because the market's vulnerable because of the fall, look. Don't forget, you don't get stopping volume near the top here. You get it after you see a fall. Then the market's vulnerable because the professional players see an opportunity possibly to make some money. Right, so they have to wait for a fall. So there's the narrow spreads down bar, close in the middle. There's the high volume coming in. Right, it goes up, but we're expecting a test. Goes that, no demand, look. Well, that's all right. Now, that's why it's important to look at the background. Remember that. So there it is. Very, very clear. I suppose you could almost call that a springboard, look. They've marked it down quite heavily, closed almost on the top. It's back into this area, look. Look. Back into the area where the high volume came in, look. Now, all it's waiting for now is a move of sign of strength in the index for that to go up. Any questions on that?
Okay, it's SKF for L&E. Okay, SKF. Do you want to put less bars up, Peter?
Well, leave that up for a minute. Okay, that's all right. Well, first glance, this stock looks weak, doesn't it? We've got all these signs of weakness here, look. You've got a top reversal here, which is a serious sign of weakness. You've got an up thrust, which is a serious sign of weakness. After you've got this, so the background's there, so that makes it obvious an up thrust, look. Don't forget, they're there not to help you. They're there to, as that's rallying, you think, oh God, if you shorted this, I made a mistake. That's what they want you to think. Comes off, bit of a shakeout, another attempt to go up, but there's another top reversal by the look of it. So you've got loads of weaknesses here. Loads of red arrows, look. A little bit of strength coming in, a little bit. On that, they mark it up, look. That looks like another up thrust of some sort there, look. So this stock looks weak to me. Any questions about that? You could draw a trend line on that, Peter. First two highs, first low. Peter's going to draw the trend lines. I find it difficult to pass a chart without drawing these trend lines on. That's right, good. That's it. Now you can see this up thrust here, we're grossly overbought. Right. There's been a certain amount of support here because when you see these a stock like this failing to reach the lower trend line, there's instant there and one here, it shows there must be a little bit of strength in there. But you certainly wouldn't risk going long on a stock like that at the moment, not fresh. Any questions? No? Park, Apple. Okay, Park. Now this Apple, of course, obviously acting stronger than the index, look. We all know Apple's a fantastically good stock. Wouldn't expect it to come off very much. It's just trending around. Well, I've said trending with the index. It's not. It's acting stronger than the index, isn't it? So there's not a lot I can see in that at the moment. But I can see we've got a principle here, look. Remember, I've told you many, many times recently that when you see a red arrow, it's probably no demand, is it? Especially no demand. If you see a test right within the next 1 or 2 bars, there it is. No signal on it, unfortunately. A test is a red down bar on a narrow spread, usually closed in the middle. This one's closed on low, and the volume is low. Oh, isn't it? Oh, sorry, I can't see that. So there is a bit of supply there, but it's still a test, look, after this red arrow. So you would expect. So they've gapped it up, probably on some sort of news, look. Something's happened. It's obviously, it's actually stronger than the index. That stock is certainly looks more bullish than bearish, definitely, at the moment. That stock is not bearish. That's a very powerful stock, dying to go up, but it won't go up unless the index becomes bullish. These stocks move up and down with the index. That's why we like to look at the daily charts of these, the Dow and the S&P 500 and the NASDAQ. As soon as strength comes in, a stock like that will go up.
This is TSLA. Yeah, TSLA. Is that Tesla? I'd assume it is. The car people. Oh, Tesla, we think. The car people. I can put up less bars.
Well, we've obviously looked at it before. We've got trend lines.
Yes.
Tesla. Oh, Peddler.
Tesla.
Never heard of it.
Tesla. Tesla. Cars. Tesla the scientist? No.
Sorry, folks, I'm not very familiar with this one, although Peter and Rita seem to be. Well, it's obviously in a downtrend, isn't it? We must have looked at this sometime in the past. There's some nice trend lines on it. Probably drawn through the first 2 highs, first low. Here, it penetrates the top trend line and becomes overbought. right? So you pay far more attention to any sign of weakness. When it's overbought, look, no demand. No, what's that one? Oh, up thrust, that's it. So obviously you pay more attention to those arrows when you're overbought like this, above the trend line. And that looks like a attempt to have a top turnaround, look, top reversal. It's been gapped down heavily on the downside, look. That's all done deliberately, of course. Anybody that bought in these areas here will be trapped. They've become weak holders. It's moving up. Seems to be going up on no demand, slowly towards its top trend line. If the index becomes bullish or starts moving, it should probably go up to that line there. But this is not the sort of stock. I'm saying, well, that's, I was going to say that stopping volume, it's not. That is probably a sign of weakness there, look. It says computer thinks stopping volume. But you've got to ask yourself, it's obviously in a downtrend. Why is it gapped down? And has it fallen sufficiently to attract professional money to come in? Somehow it doesn't look so, does it? It needs to go further. And this move up, look, it's going up on no demand. Trend line here. If the index becomes bullish or moves up, you expect this to go up to at least that trend line. But the whole thing looks weak to me. Does not look bullish.
Okay, Gordon would like to see the coffee chart. Oh. We don't think that we've got it. Oh, I saw it. Down. Yeah. The KC. Yep. Okay, coffee.
Right, coffee. Now, first of all, you could draw a trend line on those first two highs, Peter, and the first low. Yeah, make sure they're up bars. First two highs, first low. That's it. At least we've got a trend line. We've got road directions. Okay, so we can see it's falling. Now look at that. It rushes towards that top trend line. Looks like there could be a bit of stopping volume here. And that could be a down bar. Well, it is, look, low volume. So that little bit there could be bullish. And on the back of that, that's why you've got this huge widespread up. I would be sticking my neck out there if I said that was bullish, or if I said it was bearish. It's not quite clear, but it does look more bullish than bearish, because you seem to have an accumulation area here. Look, high volume. There's your test. What's that say, Peter? No supply, which is true, and that's why it's gone up like that. Now, if it's bullish, it'll continue up through that trend line. But if it's not bullish, you'll probably see up bars, narrow spreads, closing in the middle, volume low, no demand. But there definitely appears to be some strength here, look. So you've got to keep that in mind. That's in the background, look. There. And there's your test. And that's why they've got this huge widespread up. On the surface, it looks more bullish than bearish. But remember, they're a devious lot. They're not there to help you. If you're going to buy, you need to buy on these down bars. You know they're going to test. When you see that high volume, if it's bullish, you know they're going to test. And there's a down bar, look. Narrow spread, closing in the middle, volume low. Back into the area, here, look. Back into the area, look. We saw the high volume. That's why it's gone up like that. Now, if they are bullish, you're going to see it break up through the top trend line. You're going to see a test of some sort. Then you know they're more bullish than bearish. Okay? Any questions on that?
Can we put up the pound 1 hour chart for Louis?
Right, this is a chart of the pound. Right, well, the reason it's gone up there, look, that would be what they call the springboard or shakeout, whatever you want to call it. That's done deliberately, of course. Catch as many stops as possible, mislead as many people as possible. Up it goes. It does hit supply. Look at this high volume. Markets don't like ultra high volume on up bars. What's that, Pete? So you've got 2 bars there with signals on telling you the supply has hit the market, which you can see for yourself. Markets don't like ultra high volume on these up bars. And that's what's knocked it sideways, look. So right now, there's nothing much going on except it's going sideways. And it would not create too much interest. If you want to get real positions, you've got to recognize these as shakeouts or springboards. That's where you go long. Okay. Funny, they call this, well, some people call it cable. Other people call it Great British Pound. They have to call it that because all the various people they were ruling years ago, they were all using their own pounds. So differentiate between theirs and the English pound, I suppose. Any questions? All right.
I remember what I read from Thomas. Remember Thomas said when you have a VSA sequence and it falls off the chart before a change of behavior occurs, can it be disregarded in the future? And he explains himself. I had a bag holding and then 25 bars later the market was still in a downtrend. Should we be aware of that area in the future or should we just disregard it due to the lapse in time?
I wonder where the bag holding was. Are you sure it was bag holding? What chart was the bag holding on? Regis, look at the screen. The reason I say that is that bag holding is so reliable, it practically 100% marks the bottom of the market, so it can't fall after proper bag holding. Now the computer might have got it wrong, though it's fairly specific in its programming. Should be a down bar, can be gap down into fresh low ground. The spread will be narrow and the volume will be ultra high. That's bag holding. Often, normally, you've already seen some strength come in. But anyway, so no, you disregard anything that's gone wrong in the background. Or don't disregard. You keep it in the back of your mind, but you're aware it's there. But see, analyzing these charts, as I said, it's an art. It's not a scientific, mathematical deal, because you're dealing with human beings. And I must say, a devious lot as well. They're not there for your benefit. I mean, for example, even on this chart, you can see that's there for their benefit. Nothing to do with you, is it? Look. Look, why should they mark it down like that just before an up move? So they must know they're going to have an up move. That's pushed down to trigger stops off and shake people out and mislead as many people as possible. Admittedly, we've got some weakness here, but to close like that in the middle. So that's only done by skullduggery, should we say. This is supply coming in. That's what made it go sideways.
Okay. Andrew is asking, who is your end-of-day data supplier? And that is real-time data. End of day, Tom. It's real-time data, isn't it? I think. Yeah, isn't it, Peter? Yeah. Okay, CTK, Peter, for Edmund. Just checking I read that right. Yeah, CT. Oh no, sorry, that was to do with the other chart, wasn't it? I think. I think that was to do with something else. Don't worry. Okay. Right. You want to look at the S&P now? That's 1 minute. Do you want to talk about that, Tom?
So we just have a look at this 5-minute chart of the S&P future. Look. So we do appear to have stopping volume here. Look. There's a 5-minute chart. Well, it's definitely stopping volume. Look. It's been marked down. Volume has increased considerably. What does that say, Peter?
That says potential stopping volume.
Potential stopping volume, yeah. Computer's telling us what we hope is correct. On that, reverse, look. What's that, Peter?
That says bottom reversal.
Bottom reversal, which is true. There's a bottom reversal, look, sign of strength. And there's your test, look, immediately after, look. Here, look. You've got a down bar immediately after this high volume. And look at the low volume. That's bullish. However, they may still want to test this before they actually have a bullish move. So right at the moment, this looks far more bullish than bearish. But whether they're going to test that, I'm not quite sure, to be quite honest, because there is a test there, look. And there's a bottom reversal, clear sign of strength. Right, but that's down by, look, narrow spread, close on the low, that's all right. And the volume is obviously low relative to the previous two volumes. Now, whether they're going to test again, you're not quite sure, because that is so strong there, and they've tested it, so this could easily be a bullish move up. And any of those stocks that we were saying would be waiting for the index to turn around, this is it. This is where they are very, very likely to go up.
Well, whatever. TP is saying the S&P value area high is 1868.75. Value area low is 1860.75. We are inside that range at the moment at 1867, and structurally I would be long above that range and short below that range. Do you utilize these value areas to determine a better posture of trading direction?
Well, very clever. It sounds intriguing, but I'm afraid I don't. I'm not that clever enough to do that. What would you, Peter? Peter said he's never heard of it. Excuse me. No, it sounds very good. I like the sound of it, but I'm afraid I don't use that. We're slap bang in the middle of a trading range. We've looked at the S&P future right at the moment. It looks as if it wants to go up. And you're slap bang in the middle of a trading range here. So it's quite possible it to go up. But that top trend line's there. We've got signs of weakness right up the top there. And remember, they're a devious lot. They're not there to help you. They're there to mislead you, squeeze as much as they can out of you. But keep plugging away, and it'll come, you know, fairly obvious to you.
Okay, we've got nearly out of time. There's a question here, Tom. Listen very carefully. If you pick any of the high-flying stocks like Amazon or Google, Facebook, or they have all had major pullbacks into what looks like accumulation areas, waiting for the indices to make their move. Over the past many weeks, the indices look like they are trying to suck in the last retail traders as longs before the indices roll over for a deeper, healthy correction in a major bullish trend over the past 5 years. Any comments on how to see where the professional money get motivated to run the market up and push the highs again when it looks like it wants to have a healthy correction in order to shake out the weak holders and continue the bullish trend?
Professional money will take the path of least resistance. The only thing I could suggest is that for a longer term, you need to look at a weekly chart or even the monthly chart to get some idea. But we're really only geared in for what we call scalping. If you want longer term information, then Philip Friston, who's a fund manager, or even Gavin's good at it. They're the people you need to ask. I mean, I could look at it all, but if you want longer term information, you tend to want to look at a weekly chart. And that works just the same. All these time frames, they're all using the same signals, which a lot of people find difficult to understand. But you're looking at the health of the market, and it's portrayed in the bars and the volume. And that's why they all work like this. If the parameters are not there, the signal just stays hidden. So that's all I can really say about that.
Okay, that's all we have time for this week, and I'm sorry if we weren't able to answer your question. We will be back next Friday, same time, and we'll be doing the newsletter Sunday this weekend. So on that note, we'll say goodbye. Have a beautiful weekend. We will, because the sun is shining here in the UK for a change. So have a great weekend and a great week, and we'll see you next Friday. Thank you. Bye-bye.